Welcome to the deep dive. Today we're taking a really fascinating look at where some of the big money is moving right now.
Maybe more accurately, where one firm is trying very hard to steer it.
That's a good way to put it. So our sources for this deep dive are a set of commercial investment listings and some pretty detailed market commentary.
Uh-huh. And it all comes from Joseph Goslan of Eureka Business Group. You'll see them called EBG. And it's all dated December 6, 2025.
That date is so important. It really locks us into a specific moment in the market.
It does, because the whole thesis EBG is pushing is that commercial real estate, or CRE, offers this powerful, steady sanctuary.
A sanctuary from what exactly?
From the extreme volatility we've been seeing in just about every other asset class lately.
Right. So our mission here isn't just to, read off their listings. It's to really test that claim.
We want to understand the why.
Exactly. Why does EBG think CRE is the best way to build steady generational wealth right at this moment? And what are they actually prioritizing for their investors? Is it just good marketing, or are these assets genuinely defensive?
Well, the context of the market definitely sets a very anxious stage. I mean, just look at commodities.
Gold and silver?
Gold and silver prices have practically doubled in the last year. And the commentary points out that the market is completely split.
Some think they'll double again, others think they'll get cut in half.
Total uncertainty. And that is just toxic if you're trying to preserve wealth.
And then there's crypto, which has been on a wild ride.
Oh, it's recovering, but it's still pretty beat up. Bitcoin shot up to, 125,000 this year?
And then just plummeted down to the low 80s. Now it's sort of hovering around 90,000.
The key word they use is silent. The conversation around crypto, which was deafening a few months ago, is now pretty quiet. It's a nervous recovery.
Even the stock market, which is supposed to be the safer bet, is only just now inching back to its previous highs after a big sell-off.
So when EBG puts all that on one side of the scale and CRE on the other, they're really focusing on the emotional side of investing.
The stress.
The stress and the anxiety. It's not just about numbers on a screen.
That brings us right to EBG's core pitch, which I find really interesting. It's not just about income.
No, it's about peace of mind.
They argue that while everyone else was on that psychological roller coaster, their CRE investors just kept performing, increasing their net worth month after month.
And we really need to unpack that phrase they use, the mental health aspect of owning CRE.
Right.
It's not just about getting paid. It's about predictable cash flow. When you know a solid tenant is sending you a check on the first of the month, every month, it just removes that daily panic.
It lets you plan your life, your taxes, your future. You're not just gambling on the price tomorrow.
And you can see it's driving real behavior. EBG says they're seeing a huge surge of investors who are actively taking their chips off the stock market table, as they put it.
And they're moving that capital into commercial real estate specifically for that stability, for that generational wealth idea that these other assets just aren't delivering on right now.
And what makes this moment so critical, according to EBG, isn't just the stability today, it's the timing for tomorrow.
The Fed meeting.
The Fed meeting. It's just 4 days after the date on this commentary, and the market is overwhelmingly expecting a rate cut.
And if that happens, the logic is pretty simple.
Very simple. Money gets cheaper to borrow, capital starts flowing, and demand for stable, income-producing real estate is going to go up.
So they're telling their investors to get in now at what could be the bottom right before the competition heats up and drives prices higher in 2026.
It's a strategic entry point. That's how they're framing it. Not just a safe alternative, but a smart tactical move.
And they're even offering a complementary strategy call?
Yeah, to help investors optimize their year-end tax planning and get their portfolios set for 2026, maximizing that short window.
But that timing feels so specific. I mean, what if the Fed doesn't cut rates? What if the economy zigs instead of zags? Does the whole strategy fall apart?
That's the key question, isn't it? And if you really dig into the assets they've chosen, the answer is no.
How so?
They're banking on defensive qualities that work regardless of the Fed. They're betting on the quality of the tenant and the structure of the lease, not just on the market going up.
So even if rates stay high, that triple net lease cash flow is still coming in.
Exactly. And if the economy slows down, that essential service tenant, like a dentist's office, is still paying their rent. The assets are designed to be resilient.
Okay, so let's unpack those specifics. The proof is in the properties.
Let's do it.
EBG has broken down their listings into different tiers, and by looking at what they've handpicked, we can really see what best value means to them in this kind of market. We can start at the most accessible level, their under $2 million category. The focus here seems to be on unique entry points and flexibility.
That's right. These are deals for investors who want some kind of immediate upside or just a flexible way into the market.
Like this first one, a 2,900 square foot medical office space. The big headline here is that it's selling well below the county's assessed value.
And that is a huge built-in safety cushion. It immediately protects you from downside risk.
How so?
Well, when you buy below what the county thinks it's worth, you inherently reduce your chances of being over-leveraged. And they also mention it has 2 combined units, and they're offering owner financing.
Which means you don't have to go to a commercial bank in this high-interest environment. It opens the door for more people.
Exactly. Accessibility.
Okay, now contrast that with something totally different. 2.2 acres of mixed-use land out in Mesquite, Texas.
This is a different kind of play. This isn't about immediate income.
No, this is about location and what the city is planning for the future. They highlight that the city really supports redeveloping that whole corridor.
That's a bet on the government, really. City support means things like zoning approvals and infrastructure spending are likely to go your way.
And the potential is massive. They say you could build up to 84 apartments plus retail on that land.
It's a big capital appreciation play, betting on DFW's population continuing to boom and spill into those secondary submarkets.
And then for someone who wants the exact opposite, pure passive income, they have this 4,400 square foot veterinary clinic.
This is the textbook stable, low-effort investment. It's a corporate NNN lease.
NNN being net, 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 meaning the tenant pays for taxes, insurance, and maintenance.
You got it. And it has 6 years left on the lease, with 2.75% annual rent increases baked right in.
So your return actually grows over time, and you have almost no landlord duties. It's truly hands-off.
And vet clinics are incredibly recession-resistant. People treat their pets like family and will spend on them even in a downturn.
We see that same theme of essential services in the last one here, our retail strip that's about 9,100 square feet.
It's 100% leased, which is a great starting point.
And look at the tenant mix. It's so deliberate. It's a dental office, an orthopedic specialist, and a restaurant.
That mix is by design. Dental and ortho are not optional expenses for most people. They're necessities. That provides a really stable income floor. The restaurant adds little risk, but it's balanced by the medical tenants. It's security through a diversified mix of essential needs.
Okay, so let's move up the ladder. The next bracket is from $2 to $5 million, and here the focus seems to shift a little.
It does. Here they're prioritizing high-level corporate security and the quality that comes with brand new construction.
This is for the stability seeker who's willing to pay a bit more to avoid any surprise expenses down the road.
Exactly. You're buying certainty.
Take this 4,000 square foot single-tenant retail property. It was built in 2023. Brand new.
So minimal maintenance worries for years.
Plus a 15-year corporate lease, 0 landlord duties, and they include this great data point. The tenant is in the top 25% of most visited restaurants in Oklahoma.
That data point is not just fluff. It's proof that the tenant's business is viable and successful. That gives you confidence for a 15-year lease.
You're not just buying a building, you're buying a successful business's location.
Right. And new construction plus a long-term corporate NNN lease. That basically de-risks the investment for almost a generation.
Then there's this huge 22,000 square foot retail space. The play here is long-term stability. The lease runs all the way through 2033.
And they're really emphasizing the structural guarantees. They specifically call out a 20-year transferable roof warranty.
And that's a perfect example of what we're talking about. A roof is usually the single biggest, most expensive surprise a building owner can face.
Absolutely. So by highlighting that warranty, EBG is basically saying, we've removed the largest potential financial risk for the next 2 decades. That protection is part of the asset's value.
And the location data they provide is just, well, it's staggering. It's on a prime U.S. highway location with over 156,000 vehicles passing by every single day.
That VPD, or vehicles per day number, is the ultimate measure of visibility and customer access.
So for a retail tenant, that's everything.
It's a self-advertising location. A tenant is almost never going to abandon a spot with that kind of built-in traffic, which makes the investor's income stream incredibly secure.
And we're back to medical with this 7,500 square foot dental facility. Essential service again, but the security here comes from the tenant's backing.
Right. It's a corporate lease, backed by a dental chain with over 200 locations.
So your risk is spread across a huge multi-state organization, not just one local dentist.
Exactly, and they note it was fully renovated in 2024, and this is key. It's positioned as an outparcel to a Home Depot.
Okay, let's break that down. What does being an outparcel really signify in terms of value?
An outparcel is a standalone building on the edge of a big shopping center. So you get to benefit from the thousands of cars that a huge anchor like Home Depot draws every day, but you have your own visibility, your own parking, your own entrance. It is arguably the most valuable retail position you can have.
Okay, now we get into the top tier, the $5 to $10 million range. Here, the value proposition feels like it shifts again to something more institutional.
Yeah, this is where they're targeting the most sophisticated investors with assets that are virtually recession-proof.
And here it is, the big one. A corporate NNN lease guaranteed by a Berkshire Hathaway affiliate.
That name alone just puts the asset in a completely different universe of security.
It's like buying a car with a warranty personally signed by Warren Buffett.
It really is. It fundamentally changes the risk. The chance of that lease defaulting, even in a horrible recession, is practically zero. The guarantee itself is the most valuable part of the deal.
And the location backs it up. It's in an affluent area where the average household income is over $200,000.
And they mention the future potential. Multi-tenant conversion upside.
What does that mean for an owner?
It means you have options. You start with the ironclad security of that big corporate lease. But years down the road, if the market changes, you're in such a high demand area that you could split the building into smaller spaces and rent it to multiple tenants, probably for a much higher total rent.
So you get stability now and a huge growth opportunity later.
It's the best of both worlds.
And finally, there's this massive vet hospital in Fort Worth, 23,000 square feet. This thing is a statement piece for a portfolio.
It is. It was a purpose-built flagship facility built in 2018, and they note the construction cost was over $11 million.
That's not just a brag. That high cost signals a really high barrier to entry for any competitor.
It means the building is modern, it's high quality, and it would be incredibly expensive and difficult for someone else to build another one just like it nearby. That protects the tenant, which protects the investor.
And it's on a road with over 120,000 vehicles a day. It's just a top-tier asset designed to be an anchor.
So if we tie all these listings together, you can see a very clear, very deliberate pattern in what EBG is hunting for.
It's all about NNN leases and essential services.
Over and over again. Veterinary, dental, medical, orthopedic. These are non-discretionary services, businesses that thrive in good times and bad.
So they're selling investments where the landlord's risk is almost zero, and the tenant's business is built to withstand an economic downturn.
That is their entire risk mitigation strategy in a nutshell. It tells you their target investor is not some speculator looking for a quick flip. They are looking for maximum capital preservation with steady, predictable returns.
The exact opposite of the gamble in crypto and commodities.
And we should mention that EBG, they've been around since 2008. They are specialists in the Dallas-Fort Worth market.
Which explains why all these properties are so localized. Their expertise is deep, not wide.
And that local knowledge lets them get incredibly specific with demographics. They're not just saying DFW is growing. They're pointing to a 1-mile radius with a $237,000 average household income.
They're cherry-picking the absolute best submarkets within a great market.
For maximum security.
So, to wrap up our deep dive on the EBG strategy, the main takeaway is that commercial real estate is being positioned as this powerful, steady alternative.
The calm in the middle of the storm of volatile assets like gold, crypto, and even the stock market.
And the strategy behind that is crystal clear.
It's NNN leases and corporate guarantees for security. It's finding properties below market value for built-in upside. And it's a relentless focus on high-traffic locations with essential service tenants.
All within that booming Dallas-Fort Worth area. It's a very structured, very defensive playbook.
Designed not just to survive a storm, but to consistently grow your net worth month after month.
Which leaves a pretty important question for you, the listener, to think about as you look at your own portfolio heading into 2026.
Given that so many of these premium listings are focused on essential services and tenants backed by massive corporate chains, what does that really tell us about how sophisticated investors are pricing recession resilience right now?
Are the financial promises of huge corporations, their lease guarantees, now considered the single most valuable asset in real estate?
Maybe even more valuable than the actual brick and mortar itself. Something to chew on.